How can, it's just absolutely not true. Then how could you have more money than what you put in, Dave? Dave. Dave's bias is destroying the truth here. He is like, read a book from the 1950s and forgot that we're now in 2020. All right, I just barely did a reaction video of Dave Ramsey, and you're about to watch that, so I'm filming the intro after the fact, but it's egregious, it seems illegal to me, it's irresponsible, it should be malpractice, it's misleading, it is absolutely insane, and I kept my cool for the most part, and I understand where he's coming from, and I concede where there's some really good points in there, but it's absolutely something that is damaging when it comes to people's finances, and you need to make sure you know how to avoid these missteps and mistakes that he's putting out there in the world.
Jason is with us in Detroit. Hi, Jason. Welcome to the Dave Ramsey Show.
Hey, Dave. Thanks for taking my call. How are you?
Better than I deserve. How can I help?
Well, I had a question for you. I've been working with a financial advisor who's given me some advice, and I follow the show. I'm on baby step 7 currently. But he presented me with an idea that was a little outside the box. And I have term life insurance. I've been anti-whole life. But he presented me with this infinite banking concept.
Jesus, you're kidding me.
Money. Yeah, I have excess money in a savings account and looking to rebalance my portfolio to get it to work a little bit harder.
Wow.
But my risk tolerance is a little bit low. And he showed me how you can do this where you overfund the whole life policy. Yeah. You can access the money. You break even in year 7, and then the dividend outruns what you put into it.
Yeah, it
doesn't seem like a terrible idea in that regard, but I just wanted your take on why, you know.
I like that anyone even asks him an opinion about life insurance. He's made his mind up long ago that no matter what you show him, no matter what you say, no matter who's doing it, like, there's everything from private placement life insurance that the ultra-wealthy does to premium financing, where you can actually get a bank to finance it at a lower interest rate than hopefully what you're doing. And I mean, I'm talking like we've seen them at a 1.25% interest rate on the loan, maybe getting 2.5% on the policy with downside protection, and you can just see his disgust already. Like, he's already got an opinion. This guy's saying it breaks even at year 7, and then it starts to have a positive dividend after expenses after that. I've seen policies that get there sooner than that, but overfunded means that you're putting extra cash into it. And Dave's going to say, well, why would you want to put extra cash? Well, why would you put extra cash into a mutual fund? Why would you put extra cash into a bond? It's if you're getting a return on that. The problem with bonds is bonds have capital appreciation risk. Like, let's just say that you have a bond and interest rates go up. Well, if you want to sell that bond, you have to sell it at a loss because you have a lower interest rate, so you'd have to compete with the higher interest rate. So there's a capital appreciation risk where you could lose money in that, where in a policy, you might be protected from liability and bankruptcy, but also be protected that once the money's made, once the cash value is there, it's got a minimum guarantee. Now, I believe that Dave is right on a lot of things when it comes to life insurance. I've seen horribly designed policies that have anemic returns that takes 20 years to break even. He should rail against that kind of stuff for sure if we're looking at it from a cash value position, but he has these preconceived notions and these biases that don't allow him to consider there might be other options. See how my prediction goes.
That might not be the best way to go.
The problem is that where it gets confusing is that, God, he's selling a dividend. A financial advisor? This is an insurance guy.
Well, he's both. They have, you know, it's one of the bigger companies.
Like Northwestern Mutual or Prudential.
Exactly.
Yeah.
Yep.
Okay. He's an insurance guy. He's not a financial advisor.
Okay, I was about to say.
So, because those are both mutual companies. Now, there are 2 types of life insurance companies: mutual and stock. Okay.
He's right.
Likely you bought your term, unless you bought it from him, from a stock company. A stock company, stockholders own the insurance company. A mutual company, which is Pru and Northwestern, State Farm is mutual, is the policy holders are actually the stockholders. Okay?
Okay. Yep.
So when the company makes a profit, the policy holders receive a dividend, as if they were a stockholder and received a dividend. Does that make sense?
Yep.
Now, follow the math here.
Well, here's the thing. Stock companies also pay dividends. It's just that they're splitting their dividends between stockholders and policyholders. Mutual companies are owned by the policyholders, so the dividend isn't split. So I actually prefer a mutual company for my overfunded cash value policies to a stock company, but let's see what Dave has to say about that.
If you are the owner of the company and you're also the customer of the company, and the only place the company gets money is from the customers that are owners, and they give you money.
He says the only place that the companies get money from is the customer. Well, the reality is there's a portfolio that they have. They're putting their money to work. They can, sell term insurance, which only pays out 1.1% of the time. So term insurance becomes extraordinarily profitable for the insurance companies. And if you're the mutual company where they're paying you dividends, not just a stockholder, well, then guess what? Those term policies that don't pay out becomes money for you. The second is they can invest the general account in a very conservative way. And this guy says he's risk averse, so that's actually pretty consistent with what he's saying. And third is if you actually borrow money from the company and they use your cash as collateral, there's interest that could be earned for the company there. So there's plenty of ways that this company can make money. They might also sell disability insurance. They may also, all these companies are definitely selling term insurance, and they might be selling other stuff that I don't really love, like variable universal life, which has, a chance to have much, much higher expenses and doesn't get paid dividends. It's all based upon separate accounts and mutual funds, which Dave tends to be in favor of, is these mutual funds.
Money from a profit, by definition, that means it's because they took too much from you as a customer. There wouldn't have been a profit otherwise.
Okay.
So the IRS has deemed, consequently, that mutual life insurance company dividends are not dividends in the true sense of a dividend, that instead they are, and this is the IRS's language.
So here's the thing, if you were to actually go to cashflowbanking.com and have them analyze and show statements, if what Dave is saying is true, then how is there a positive return? This guy's saying at year 7 it's break even, then you're going to have more cash than what you put in the policy. How could that be possible if Dave is saying, no, you're just getting a portion of what you put in, and now you've overpaid? Well, if you overpaid, you would get a discount, or you would get some money back, but not all your money back. So he has such faulty logic in this.
They are instead a refund of a deliberate overcharge. So they overcharge you in order to give you some money later to make you feel like you're making money off of them.
Then how could you have more money than what you put in, Dave?
It's a pass-through. Mathematically, it's a pass-through. It's the way it has to be. It's the legal definition of the freaking company, and the IRS says so. So,
Dave.
The thing I didn't love is, when you take the money back, you basically are paying an interest rate on it.
Exactly. And whose money is this?
Well, and let's be clear. You can take withdrawals, and it's FIFO, first in, first out. So you put money into the policy, and the first dollars you put in are the first dollars you can put out. You only would pay taxes on money that is above and beyond what you put in. And if you look at the policies, and you even look at, there's a guaranteed side and a non-guaranteed side on overfunded whole life policies. The guaranteed side is if they never paid a dividend ever. And the non-guaranteed side becomes guaranteed once a dividend is paid. The dividend is basically the minimum guarantee plus an extra portion based upon their overall returns on their portfolio, the amount of money that came in from all their term insurance, and the things that I talked about before. So he's leaving out so many things and acting like he's an authority. Dave's bias is destroying the truth here. And for someone that claims to be a truth seeker and a truth teller, I mean, it's crazy. He's against index funds. Says just put it in loaded fund, even though the stats are showing after 20 years, a lot of those don't outperform, like the majority of the time, the index funds. And I'm not a fan of either necessarily, because it's usually handing money over to things that don't create cash flow, that you don't have control over. This cash value, if we're just looking at, like, what if you had savings, and savings accounts do very little in interest. They're fully exposed for liability. You have to pay tax on it. And if you could get a higher dividend here and have more cash, why wouldn't you? And he's saying that that's not possible based upon definition. Well, whatever your definition is, Dave, look at the reality of a policy instead of just coming to these conclusions.
Right.
That you're borrowing your own money and you're paying them.
Okay, so, and let's talk about this thing, you're borrowing your own money. Well, you can take the withdrawals, as I mentioned, or you could borrow. And what happens is you could use your money as collateral where it still earns interest and dividends. And there's two ways to do that, either participating or not participating. One impacts your dividend slightly, the other one keeps it the same. And then they charge you an interest rate for the money that they lent you based upon your money as collateral. And so you could have access to that money without tax, without having it hit your credit score, with having whatever payback period you want. And if you don't pay it back, it subtracts from the death benefit. So again, only giving a very small soundbite piece of the story, which is frustrating for me because he's a very intelligent, business-savvy individual.
Interest? Yep. This is infinite banking for them.
Yeah.
Yeah, the infinite banking concept is old school whole life done
it's not
poorly.
Old school whole life, because old school whole life wasn't really overfunded with paid-up additions is what it's called. And they didn't have an increasing death benefit, which I've done another reaction video where Dave says, oh, the death benefit remains level and you don't get both. He is like, read a book from the 1950s and forgot that we're now in 2020 or 2021, depending on when you're watching this video. So it's just a little bit insulting to give partial advice for someone who's pretending to be the authority.
Real financial advisor, not an insurance broker that's trying to sell you a load of manure.
What makes a financial planner a real financial planner versus an insurance advisor? There's plenty of insurance salesmen out there that's what they do. And, you know, I used to say I was a financial advisor in 1998, even though I was basically selling life insurance and I had a Series 6 and 63 where I would sell mutual funds. And so I wouldn't call that financial advising, I'd call that financial selling. You know, I wasn't the actual fund manager making the trades. I was just giving them charts and giving them stories that were regurgitated from what the firms had trained me. Like, real financial planning to me should be, do you have an estate plan? Do you have the right credit score? Have you negotiated better interest rates on your loans? Have you maximized your tax savings? Have you chosen the right corporation? If you're a business, you know, have you thought about basic things to create economic independence where you have enough cash flow coming from your assets rather than waiting for 30 years through accumulation, hoping that the stock market's going to save you? So there's a much more comprehensive picture when it comes to financial planning. And if you go to wealthfactory.com/private, you can actually fill out a few questions and you know, or wealthfactory.com/strengths and take a financial stress test to see how effective is your financial plan. Because we're bagging on the insurance advisors, and I get it, a lot of it might be well deserved, but this is with false or partial information, and then just assuming that everyone that sells the mutual fund's a financial planner. I hope that he defines what a financial planner is here.
And so, yeah, the other thing is that your cash values that are sitting there all die with you. So whatever cash you put into this,
again, he doesn't understand that dividends increase the death benefit. And if you look at illustrations from many mutual companies, you're going to see those death benefits increase over time. That's because there has to be a corridor between the cash value and the death benefit. And as that cash value grows, it pushes that death benefit up. So again, he's talking about policies from the 1950s that were flat death benefits. And yes, when you died, you didn't get the cash value. But now the death benefit increases over time with those dividends. And so I have policies that started at, you know, when I was really young at $100,000 that are now, they're worth more in death benefit today. So it's frustrating.
Equals zero at your death because they only pay the face value. Pru does not have a policy.
He's talking about Prudential. I don't know anything about Prudential. Don't use them. Don't have any policies with them. Although I have one with One America, Mass Mutual, Penn Mutual, you know, Guardian. So I've got a few different policies, a few different companies, and all of the death benefits are higher than where they started, and all the cash values, you know, after a certain period of time. One of my policies at four years actually hit break even. I do have some that took closer to 5 years. It really depends on how you fund these types of policies. That's why the overfunded kind of thing you see it down there at the bottom of the screen.
Northwestern Mutual does not have a policy that pays more than the face value, except Universal Life Bs, which are not in infinite banking products.
No, and again, he's absolutely incorrect. If you look, you're going to see the death benefit grows. The death benefit grows. He's not mentioning that. It's the face value is what you start with, but then that face value grows over time, and he's not telling you the whole story.
And Universal Product B is where they charge more than they usually charge, which basically buys the insurance so they can still keep your money, is the way the math actually works on this. So you're dealing with one of the most expensive insurance products in the marketplace. If you're dealing with either one of those two companies, I would stay completely.
I just say, like, the way Dave views everything is as an expense, and there's 4 types of expenses, and this is really helpful to understand. One type of expense is a destructive expense. So if you're spending money on something that is leading you into debt because you borrowed for it, if you borrow to consume, that's destructive. If you're paying for something you're not utilizing, that could become destructive. The second type of expense is lifestyle. It's just pay cash for those things. Dave's got a good idea around that, don't borrow, right? So you pay cash for those lifestyle things. The third thing is protective expenses. This is everything from building up some liquidity and having asset protection or estate planning or corporate structures or insurances so you can transfer risk. And then the fourth type of expense is a productive expense. To me, a productive expense is if I put in $1 and more than $1 shows up, it's productive, and I'm just measuring how productive it is, so I'm maximizing my dollars. So he's just thinking all expenses are the same. So he's saying, hey, if you're going to pay $2,000 a month for a overfunded whole life, and you could just go spend $200 on term, well, the problem is 98.9% of the time that term insurance doesn't pay off, so you have those dollars that go out, you didn't get to invest them, it goes away, and you're guaranteed to die one day. So what about those people that have a permanent policy that is actually going to pay out when they die? They could actually start utilizing those benefits and use it in coordination with other assets in order to increase their cash flow. If you go to billionairesmethod.com, for a few bucks you can get my book, and it actually demonstrates this on the buy net worth, don't build it, and it's actually showing you how to use assets together in coordination to increase cash flow 20%, or in some cases as high as 50%. So it creates buoyancy and contingencies and all this kind of stuff that he just is absolutely blind to. And I don't know why he's never looked at bank-owned life insurance, corporate-owned life insurance, non-qualified deferred comps. There's all these other things that the ultra-wealthy they've always done. And the Rockefellers are buying policies, and then those policies pay off when the heirs die, and it keeps replenishing the trust. And then they use that in a very tax-efficient manner to build their own system where they don't have to use normal banks. But he's not talking about any of that. He's just saying higher price equals worse product. Well, guess what? You can go out there and you could pay for a flight, and that flight might only be $1, but if they don't have mechanics and they use everything that is just broken and scrap, and they don't train their pilots, it's not gonna work. You're not gonna make it. And so we have to understand price versus cost versus value. Price is what we pay. And some people only look at minimizing that price, and unfortunately spend a lot of time trying to save money, but they aren't thinking about how to produce value. The second is cost. Cost is the economic impact. Say I have an account and I have to pay $500 to, and there's another account for $250, but the one I pay $500 for saves me $5,000 more in tax. Well, I did pay $250 more, but I still had a lower cost even though it was a higher price. And then finally is value. What value do you have for peace of mind, for knowing that it's going to be there, that it's not just going to go away, knowing that you could access that cash at any time, knowing it's protected from liability and bankruptcy, knowing you could use an accelerated benefit rider on the death benefit, so if you ever need long-term care, you can actually use that death benefit while you're alive. What about paid-up additions and the dividends growing over time and the dividends becoming guaranteed? Don't want to talk about that, so I challenge you to just go to billionairesmethod.com, pick up the book, read it, and you're going to see the second or third chapter. I absolutely dispel what Dave Ramsey and Susie Orman have wrong and why they believe that. It's in their framework and their perspective, and that determines what we teach. And his perspective is it's expensive. And in his world and in the way most policies are designed, that's right. But you know what? There's another 10% of the time that it's absolutely harmful and wrong, and if you learn that, I think you're going to end up keeping a lot more money, having a lot more safety, and dispelling a lot of the misinformation that he's spewing on this video.
Want to continue the path to be a better investor? Make sure that you're not losing money and taking too much risk? Well, click here and learn about strengths vesting.